Welcome to a special episode of HP Unplugged, where we decode the world of money with one of the sharpest minds in finance. Today, we are joined by a true pioneer, Ms. Devina Mehra, Chairperson and Managing Director of First Global, known for her data-driven investment philosophy and unmatched clarity in market commentary. At HPCL, we are part of a professional ecosystem where consistency, structure, and responsibility shape our daily lives. But when it comes to personal finance, many of us still grapple with questions like, where should I invest? How do I plan for the future? What if the market crash? In this conversation, Ms. Mehra helps us understand how even those with modest beginnings, structured incomes, and long-term responsibilities can navigate the world of investing with confidence and clarity. Hello ma'am, and welcome to HP Unplugged. We are truly privileged to have you.
Thank you so much for having me, and I'm glad to be part of HP Unplugged and one of the first few speakers, I believe.
Yeah. Ma'am, actually we are now diversing towards speakers from outside HPCL to get an outside-in perspective of it. This is the first episode where we are going to discuss about finance, the personal finance, which is a very important topic because everyone wants to enjoy financial stability, but may not have that time or risk appetite to actively trade or follow the markets, what is happening in the market. Just wanted to know about asset allocation and your approach towards personal finance.
I mean, you're so right. I mean, a lot of people I know work hard, but they don't make their money work hard for them.
Yeah.
And that does not mean trading. You mentioned trading.
Okay.
So a lot of people don't get started thinking that I don't know enough.
Okay.
So the important thing to know is that you don't need to understand every last thing. You don't have to sound knowledgeable in parties that I found this multi-bagger stock.
Okay.
You have to get the broad things right. And broad means what? You have to get, first of all, the asset allocation right. So that's, and I always say, like in Google Maps, you don't just put the destination, you have to put the starting point. So the starting point is to look at how your assets are allocated currently. So it sounds very fancy, asset allocation, but it's actually quite simple. So you look at categories of assets. So equities means both direct holdings you may have in the stock market as well as equity mutual funds or equity portion of mutual funds. Then there is fixed income, where there's also fixed income mutual funds, but there are also things like PPF or bank fixed deposits, anything which is in the debt category. Then you have things like gold and silver. You might hold real estate, either something you bought yourself or something that's come down from the family, land, apartment, house, whatever. Maybe you hold something else like crypto or art. So so first look at what you have, as well as of course your liabilities, house loan, car loan, or anything else. And then look at where you should be. So for example, just yesterday in one of my groups, there was, and this is somebody from IIM who said, I'm 34, but when I looked at her asset allocation, it's like 70% in things like bank FDs. Okay. So at that age, that is too little to have in equities. So, so you have to calibrate it a bit. And you have to be not at either end of the risk spectrum. I always say that if you have everything in bank fixed deposits, for instance, and you, let us say, invest 1 lakh every year, in 30 years you will have something like 75 lakhs.
Okay.
Whereas if you have in something which is a multi-asset portfolio, even let us say compounding 9.5%, you will have maybe 1.7 crores. If you are
that's much different.
And yes, and if you are in something that's compounding 12.5%, you will have 3 crores. That's 4 times. So that's why it makes sense to do conscious asset allocation, but don't be at extreme end. So I sometimes find people say, I've never invested in equity markets and now I want to quit my job and become a day trader. Okay. or trade crypto. Okay. So don't do that either. And one other thing which often Indians miss out on is global diversification.
Okay.
So you have to look at that. Especially I find
global diversification in the sense
investing overseas.
Overseas, okay.
Because India, after all, is only less than 5%, not even 5% of the world market capitalization.
Okay.
So there's no reason 100% of your money should be there. And one statistic which I often give is that when I started working, the dollar was 12 rupees.
Oh.
So in the course of less than a career, there's been a nearly 90% depreciation. So when you're talking of goals which are 20, 30 years away, you have to take that into account.
You have to invest outside as well.
So those are the things. But manage risk. So especially in equities, manage risk, and two broad things: always have a stop loss, and make sure you're not concentrated in just 2 or 3 industries. So be diversified. At least that much basic you should do. And the third thing is to start investing. So I mean, there are all these calculations available that if you start investing at 25 versus 30 or 35 or 40, how much more you have to invest every month. So even if you can't save a lot, sometimes young people tell me that I can't save a lot. So I said, I can't save like 25% of your salary. I said, start with 5%, but the next year's increment save 70% of that.
Okay.
So at least start, because the sooner you start, the easier that target will be to reach.
We spoke about asset allocation. So is there a right formula or right percentage for a person? Suppose he's 35 years old, then he should have this kind of an asset allocation, like this much percentage in FD, this much percentage in equity. And suppose a person who is suppose touching 45, they should have this kind of an asset allocation. Is there some kind of a formula, benchmark which is there, which can yield to better results?
Actually, it has to be tailored to your circumstances. So even sometimes very young people tell me that I'm 25 and in a good job, should I be 100% in equity? No, you should never be 100% in equity. Because equity essentially should be money you need not touch, or you should not touch for at least 8 to 10 years.
Okay.
So, I mean, there are always interim, something you have not budgeted for. You want to study abroad, or your child wants to study abroad, you lose your job, you have a house to buy, there's a medical emergency. So you should have a reasonable amount in non-equity also. The rest of it depends, again, as I said, how many dependents you have. Are your parents dependent on you? Do you have children? When will you need money for the children's education, for instance? So it has to be calibrated for each person. But as I said, don't be on extreme ends. Don't be in 100% fixed deposits. Don't be in 100% equity at any stage.
Somewhere within 50-50 or...
maybe when you're younger, it should be more than 50-50. Yeah.
More in equity, less
in equity, yeah. When you're like 25-30, it should be probably more in equity. Provided, as I said, you don't have a lot of dependents. And then, as you're older, then... so again, when you are retiring, for instance, any money that you need to withdraw for at least the next 5-7 years should not be in equity. Because equity returns are not predictable for the short term. Equity returns are very lumpy. So, to give a very extreme example, from 1994 to 2003, for 9 years, if you look at from a point, there were of course ups and downs, but on a point-to-point basis, the Indian markets gave zero return.
Oh.
And then from 2003 to 2007, they went up 6 times. So, it can be as bizarre as that.
That bizarre and volatile.
Yes.
So that should be like, you should have something for the volatility and also for your stable condition, so that if you have some nearby goals, so that you can
yes, because what happens is that even if on the average equities give X return, if let us say that you retire and you put all your money in equity, to give an extreme example, and the market goes down for the next 2-3 years and you still have to withdraw for your annual whatever expenditure, then your corpus itself is dropped. So even though on the average you get the same return, actually your money will not last for that 25-30 years that you had budgeted for. So that's why. The order of the equity returns makes a difference if you are withdrawing out of it.
Okay.
So therefore,
we need to keep changing our asset allocation as we age and as per our goals are.
Yes.
Okay. Ma'am, you talked about starting, at least. So, the market keeps going down, up. People say that, wait for the dip, buy at the dip. We never know what is the dip, at what level it will go still. So, what is the right time, according to you, to, enter and start investing?
So, most of the time you just should keep investing most of the time, because
I guess SIPs, sustainable.
that sort of thing, because especially in the current thing, because you had I was talking about how erratic equity returns are. So 2010 to 20 was a decade when the equity returns were very low. I mean, for the whole decade, the equity return was about the same as what you would have got in fixed deposit.
Okay.
So about 8% fixed deposit. This was maybe 8.7%. So you didn't get any return. So that's why last 5 years have been very good. But then of course you should not take that these last 5 years is the kind of return that equities will give always. But the thing in equities is that if you look at a very long period, even 40 plus years, if you were not invested on the 10 best days of the market, you would think in 40 years what is 10 days, but you give up 2/3 of the returns. So if you had put in 100 rupees, which would have become, let us say, 80,000 today, if you had not been invested on those 10 days, 2/3 of that return would have gone. So you would be only at some 25,000, instead of whatever 75, 80,000, you'll be at 25, 26,000. If you miss out on the 30 best days, 90% of your returns are gone. There are only very outlier times when you think that you should not be in the market, because most of the time when I get this question from the audience, sort of in any speech, that should I be out of the market, is exactly the time when you should be invested.
Okay.
If at all you should think of booking substantial profit, it is when things are looking very good, as it was the case last year. For the first 8-9 months, people thought that the markets will always give you grand return. So that's when you have to pause and think that am I this genius, or is there something unusual happening in the markets? But most of the time, you can't really time it to that extent. So better to be invested, but with, as I said, for individual stock positions, have a stop loss. And also remember that if you are invested, let us say you invested in something last year and that has fallen, you don't have to make it back in the same stock. So a stock that has fallen from 100 to 60 might still be a sell. Because there are, in every bull run, there are stocks that go up like crazy that never come back to those levels. There are many stocks disappear altogether. This also people do not realize that currently about 4,500 stocks sort of trade on a consistent basis. If you look at the number of total listings in the market, they have been many times that. So many stocks just disappear. So in every bull run, there is a different set of stocks that does well. So there's nothing like buy and hold, and this will have high conviction and remain invested and buy when a stock goes down. No, those are not good ideas on a stock basis.
We spoke about stock trading, buying at the dip, and all those things. Now, for a nascent investor who does not understand all those jargons, and is it better to go for SIPs and buy mutual funds, because there somebody else is assessing that particular stock, and somebody else who is an expert is managing that stock. So is it better to go for the mutual funds?
Yes, I think it's definitely better to go for professionals. So mutual funds, portfolio management schemes, or some kind of advisory service, definitely. I mean, I'm of the view that most of the time they would do a better job than you can, because you have a day job. This is not your full-time job. And I say that don't use equity markets for entertainment, for that I should be able to talk at parties. If you want to do that, keep a small portion for that, 10-20% of your corpus as play money. But don't do the bulk of it yourself. For most people, that would be the right advice.
Understand the entire dynamics of the market, because you said that those 100 days when you need to trade.
Those 10 days, if you and those 10 days, interestingly, Sudipto, come when there is fear, when there is anxiety, when people are asking, should I be invested? They don't come during bull runs. Bull runs, the market doesn't run so fast. This fast move comes from the bottoms.
That's a good thing to take away from this, because most of us who are listeners do not have that kind of an understanding. There are many who are very much experts, but there are many who do not understand it, and they want to start. So it is better to start with somebody who is an expert. So go towards mutual funds and then buy.
As I said, have your broad asset allocation right. So because most 80-90% of your returns come from there. So it doesn't matter that you don't understand the last bit or you have not got the very best stock in the market,
Correct.
which your friend was boasting about without telling you
How much he has lost.
Yes,
somewhere or
exactly.
something. Yeah, so that's a lot of peer pressure actually when you
the
talk.
FOMO feeling.
FOMO feeling, yeah, that oh I have lost, oh he has gained so much, yeah. So that is there.
And in fact, just to
Yeah.
add to that FOMO thing, one thing which you should be cautious about, we talked about mutual fund, is people ask me that when is there excess in the market or which areas have an excess. I said a very good rule of thumb is that whichever theme you see a lot of new fund offerings, a lot of thematic fund launches from mutual funds, that is normally around the peak of the cycle.
Oh.
So that mutual fund things is with a caveat. Normally, when you will, and it's not just a 1-2 year thing. If you see when IT funds were launched, when pharma funds were launched, when small caps were like last year, you saw a lot of money going to small caps or to defense or something like that. So those are, I mean, this we have plotted is normally very close to the peak of that cycle, of that theme. Okay. So when I say mutual funds, go into broad-based multi-cap, multi-asset, those sort of things, not very narrow focus, because very narrow focus, especially at the time of the new fund offering, is a losing bet almost always.
Okay. So that's a good thing to know.
Yes.
Also, there are many advertisements which are coming now. Mutual fund sahi hai, and you need to hold the mutual fund for these many long years. So, what is your take on that? How long should a person be looking at when they are buying mutual funds? How long they should hold?
At least in a category, if not that specific fund, yes, you should be invested for a longer period of time, because that whole compounding
10-15 years?
Yeah, I would think, because that's when you get the compounding. Whereas on the average, the average mutual fund investor does not hold for 2 years even. So that's why you don't need to. So you often get in at the wrong time and get out at the wrong time. That you get in when there is euphoria, and when things are down in the times you get out. So that's always a bad strategy in anything. I mean, I remember in 2021 there were a lot of Nasdaq funds that were launched in India.
Okay.
Not in hindsight, but that time itself I said Nasdaq has done so well of late 3-4 years, it's not going to last forever. And next year Nasdaq was the worst performing index in the world. It fell 40%.
Okay.
So people asked me that should I get out? I said now you don't compound a bad buy with a bad sell, because as I said the stock.
Now you buy.
Yeah, at least don't sell. So I said like in the stock 40% down, it might still go down another 40% or another 90%. But a major index down 40% is normally not a sell, because then it will be somewhere around. And then of course next year it was like again doing very well. So that those kind of cycles happen. But as I said, don't get married to a stock or a strategy. Because if you look at even what were called blue chips, if you look at the original Sensex list, most of the stocks are no longer relevant. I mean, they were paper and textiles and shipping and premier automobiles and the makers of Hindustan Motors, the makers of Ambassador, those kind of stocks, and they were the blue chips of that day. They were those groups like Thapars and Mafatlals and JK, so all of which have got swept away into history. So there are always cycles. I mean, 20 years ago there were no banks or financials in Sensex and Nifty. Now they are the highest weightage. So it all changes.
It all
yeah, it's a giant wheel.
Yeah, so that is what is happening. The average investor, when they look at the TV, there are so many opinions which are coming. You just browse through the channels and different opinions are being projected onto you. So you do not understand that what is the indicator or what is the data point that you should go with, because you have always emphasized on data to break the clutter. So what is your take on that? Which data or how do you infer the market through data?
First of all, don't spend your time watching business TV.
Okay.
People think that that's a good use of time. It is not. Because see, they have to fill up 24 hours a day. And everyday movements in markets are basically statistically random.
Okay.
I'm a student of statistics. But every day they have to find one reason why this happened. So if the market goes up, they will find some reason. If it goes down, they will find some reason. And so also the newspaper headlines. One day we are moving up because of the US, next day we are decoupled from the US. Something or the other, some story you will make for why the market did what it did, but it is mostly random movements. So whenever, as I said, better to leave it to professionals, but whenever you're doing it yourself also, then stick to the data. Again, discussing too much even with your friends is not a good idea, because that also,
because they might have something on their own.
And then, I mean, this is in theory, or studies have shown that when you pool independent opinions, suppose I put a bowl here and put some marbles in it, and I ask 200 people how many marbles are there in the bowl, the average will be pretty good compared to the actual number, because you are pooling 200 independent opinions.
Right.
But when you sit, and this is true of corporate decisions also, when you sit around a table and discuss, the quality of decision making goes down, because it depends on who speaks first, who's the boss, who's more powerful, and a lot of fence sitters will go with whoever, wherever they think things are going. So that's what happens when you discuss, the quality of decision making goes down. So that's why there are books called Wisdom of Crowds and there's a book called The Madness of Crowds, because when together the crowds can go crazy. So,
Ma'am, I wanted to talk about women and financial autonomy. We see a lot of women who are earning a lot of money, but again, when it comes to managing their money, it is being managed by someone else, and they are pretty scared to get into this investment thing. So what is your advice on this to all the women colleagues here in HPCL, that when should they start, and whom should they trust with their money?
I mean, this is a cause for me, because you're so right that even women professionals don't manage their own money. And as I say, that till you manage your money, till you have financial independence, you have no independence.
Right.
And there are a few reasons for it. One, of course, is that often the women are managing too many other things, including household, children, this, that, and the other. And they think this is one thing the husband is happy to take care of, so let him take care of it. But that's a wrong thing to say. The other thing is that just because the men in your household act as if they know doesn't mean that they know. Confidence is not equal to competence in any field of life. I mean, it's true in recruitment also. I learned this through recruitment mistakes. That somebody is confident in an interview that they know something doesn't mean that they really know it. And then there are other things, like there are also these societal things that if you're, let us say, in a risk asset like equity, at some point you will lose money. So when a woman loses money, she thinks, and everybody else thinks, why did you do it? You didn't know, and people will like come down like a ton of bricks on her. Whereas when the husband loses money, oftentimes she will not even bring it up that why spoil the peace in the home. So there are all these said and unsaid biases. But I tell women that, again, the same thing, that you don't need to know every intricacies. Get the broad things right, get started, take charge of your own money.
Start from somewhere.
That's why I never say no to ever addressing women, even if it's a very small group, because this is a cause for me that women should take charge of their finances.
We spoke about, ma'am, a lot on the equity thing. There are many other type of investments as well. There are a lot of insurances which are saying that this is a very good investment, that you're not only protecting yourself but investing also. But there is a lot of buzz in the market that you should not buy insurance for investment purpose. You should buy insurance for insurance. So what is your take on that?
Yes, that's exactly right. You should never buy insurance for investment purpose. And the unfortunate part in financial services is that there is a lot of mis-selling. So this is what is called an agency problem, that someone who's advising you, their well-being is not aligned with your well-being. So they will be selling something which gives them the maximum return, the maximum fees, or whatever cut. So whether it is mutual funds, whether it is investments like selling insurance, which used to be rampant, especially the ULIPs and all that.
Correct.
So also have basic financial literacy. So this also, I mean, at least know how to calculate an IRR on an investment. So once you calculate an IRR on any of these, you will be able to see what is really happening. How much is going to the agent, what is actually getting invested, what is the return on that. So at least I mean, I think in schools itself we should have basic financial literacy. So don't use insurance for investment. So that is sensible advice. So investment should be separate. In terms of other assets, see, our grandmothers were not wrong in buying gold, because at that time there was no capital account convertibility. You could not invest overseas.
Correct.
So gold was the only thing that gave you a currency hedge. So even though in dollar terms the gold chart is like this, so I don't know how many people know that the gold price of 1980 did not come back till 2007. 27 years it took to come back to that level. It fell 60%. I mean, 19 years later, it was 60% down from the 1980 level. If you go to 1999, in dollar terms, it had come down 62% to be exact. And to go back, it took till 2007. But in rupee terms, it looks okay because it's essentially a rupee depreciation chart.
Right.
But now, the liberalized remittance scheme, the LRS of the RBI is very generous. So it is $250,000 per person per year. So a family of 4 can send out $1 million. So that's 8.5 crore rupees you can send out. I mean, what a contrast from the time when, not just when I started working, but well after that. I mean, I think a lot of your audience will not know this, but at that time you could, even if you were traveling abroad, let's say to wherever, you go to Singapore or New York or wherever, you could take only $500 once in 3 years. If you were going more than once, you could take only $20 and go. So it was crazy. So yeah. So.
Ma'am, one important question that I wanted to ask is beyond wealth creation. Now, investment has many objectives, like aligning with the life goals, like buying a house, then funding one's education or their children's education, and then retirement. So when should somebody start aligning their investment with the life goals?
I think right from the beginning, as soon as you can think of it. Of course, it will evolve. I mean, maybe if you start at 24, you not envisage when you will get married or whether you will have children. So maybe those realignments would happen as you go along. But whatever you know at a point in time, according to that. And now, of course, it's easy enough on the net. You will find enough calculators to tell you that that if you assume this inflation and this return, what do you need?
The net present value and all those things.
So I mean, what do you need to start investing? And as I said, even if you can start only small, start and then out of your increment or your increase in your income, you save a higher proportion. So that should be the objective or the way to go about it.
So you should always back calculate that if I
at least that will give you some benchmark as to how much you need to save, because otherwise it's very easy that you start working at 23, 24, 10 years just go by before you even think about that you need to focus on this. Because now also remember that longevity has increased. So you need to budget for a lot longer post-retirement than earlier. I mean, my mother has been a pensioner longer than she worked. She's been a pensioner for 33 years now. So so that's what you have to budget for.
Also.
Right.
Thank you, ma'am, for focusing on a lot of interesting topics, and which is going to be very, very beneficial for the audience who is listening to it. Because I know, my colleagues and my friends who are very poor with the investing thing, and they are very scared of, entering into this thing. But you have cleared a lot of doubts, and I am sure after listening to this interview, they might even change their asset allocations or start investing in a proper manner so that they can plan for their future. Thank you very much for coming to HP Unplugged. We are truly honored, ma'am.
Thank you for having me, and I hope people do focus on getting their money to work for them as well, rather than just working for the money.
Thank you, ma'am. Thank you.
Thank you.
Thank you, Ms. Mehra, for translating the complexity of finance into clear, actionable wisdom. For many of us at HPCL, your advice resonates deeply. It reminds us that smart investing doesn't require us to be market experts, but thoughtful planners. To our colleagues, whether you are new to financial planning or reevaluating your long-term goals, we hope this conversation inspires you to take the first step, stay consistent, and invest with intent. Thank you and namaskar.